Hello again. Welcome to another episode of the Uranium Market Minute. Today is Wednesday, April 27th, and this is episode number 111. My name is Justin Huhn. I am your host. I'm the founder and publisher of the Uranium Insider Pro Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. As always, nothing that you see or hear in this video podcast is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing. And always take responsibility for your own choices. Okay, thank you so much for being here. I do appreciate each and every one of you. This is going to be a relatively quick episode today, as it is a pretty quiet day in the markets today for uranium. Let's jump right into the daily scoreboard, where I will share with you spot price of uranium, spot flows, ETF flows. Price of uranium slipped a bit more today, 52.87 a pound mid-market. Again, we have spot out of the market. Not issuing any new shares, not raising any new capital, and they're not going to draw down that $28 million cash position that they're sitting on right now to buy more uranium. So basically, we're at a stalemate here until there's new flows coming into spot. Of course, other players can participate in the spot market, but on the buy side, most of the other players in the spot market on the buy side, which would be utilities in theory, are essentially mostly out of the spot market. Why? Because purchasing in the spot market currently, due to how thin the spot market is having an accretive effect on the price of the spot uranium. Now, many of these utilities still have outstanding contracts with deliveries, now-ish and going into the future. Then those deliveries are oftentimes partly referenced to the market or referenced to the spot price of uranium. So if one utility chooses to buy some uranium on the spot market, that moves the price up. Another utility, or potentially even that same utility, could be overpaying for a contract delivery with consideration of that spot referenced portion of that contract. So utilities, generally speaking, are not really participating all that much in the spot market. It has now mostly been traders and, of course, the Sprott Physical Uranium Trust, which currently is out of the market due to the factors I just mentioned. So we're looking at, let's see, SPUT closed at a discount to NAV -4% yesterday, and today did not get back up above that 1% premium to NAV. So we continue to trade at a slight discount to NAV here. Looks like the sector is still trying to find a bottom from this recent pullback that really increased in speed last week. It feels like we're at a bottom. It feels like these stocks want to move. The broad market, again, is not really helping us out here, with continued chop sideways and if not down in the broad markets. So we continue to go sideways here for the last few days in the uranium market, waiting for the next leg to kick in. As I mentioned, SPUT sitting on 28 million in cash, and they're not going to spend that on uranium. They're going to wait until they can raise more cash on their ATM. There obviously is, there's a bit of speculation about SPUT's NYSE listing, and that we are not going to see substantial flows into the sector or into SPUT until we have clarity on that NYSE listing. Now that in some cases that makes a little bit of sense, but at the same time, we've already seen substantial flows. We've seen $750 million come into SPUT since the beginning of the year. That's a lot of money. We've seen substantial buying coming from the ETFs due to share issuance, primarily by URA. So there's definitely been a decent amount of money flow into the sector already this year. So I don't know how much institutions are generally waiting for that clarity, but whether or not they get the NYSE listing, I do believe that once that clarity is in the market, then we will see perhaps a renewed interest in institutions positioning at that point. We're waiting for communication from the Sprott CEO in terms of timing on this, but we do believe that we're still within that 2 to 4 month timeframe from right now to when we will have clarity on that listing, as the application has been filed with the SEC, filed on behalf of Sprott by the New York Stock Exchange. Turning to the ETFs, URA issued a very small decrease in outstanding shares of 20,000 shares, $300,000 in mandated selling, no change for URNM. So this is noteworthy. The selling that we have seen across the sector over the past week is not coming from the ETFs. We're not seeing redemptions here. So what does that mean? Yes, of course, there is selling of the ETFs, but at the same time, the buying pressure on those ETFs has been relatively balanced. And so we're not seeing huge redemptions here from the ETF. So the selling, basically what this means is the selling is of the individual holdings that the ETFs actually hold, because they're not the ones selling it. The outflows in the ETFs have not brought those ETFs down to a significant enough discount to their net asset value to justify them selling down those holdings to redeem shares. So why don't we go ahead and take a look at the charts? Like I said, a pretty quiet day today here. URA was up 0.68% on the day. Very small volumes here. Really, we're just chopping sideways. Looks pretty indecisive. RSI is slightly ticking up here, coming off of oversold territory. Would like to see these levels hold. Of course, I've mentioned in the past, if we do see further weakness, we would definitely like to see some support at this lower trend line within this long-term Livermore accumulation cylinder. So it's nice to see that the volumes are dropping off here a bit, and we're not seeing further downside moves. So perhaps we have a bit of chop before we have a renewed leg back up into this Livermore accumulation cylinder moving higher. Sprott Physic Uranium Trust also low volumes, up almost precisely the amount that URA was up today, 0.67% here. Pretty indecisive candle. Looks like MACD still has bottomed and the RSI is trying to move up here. It looks, generally speaking, across the sector like a number of these stocks have bottomed from this recent pullback of about 15 to 20% from the highs that we saw just a few weeks prior. Same thing with Cameco. Cameco actually down about 0.5% today. Volumes tapering off. MACD trying to find a bottom here. And I think that we are, again, just chopping sideways for the most part. All right, so for the mailbag section, I had a question come to me through a direct message on Twitter asking about another post. This post came from Art Hyde from Segre Capital on Twitter. He had a really good thread today from the WNA, the World Nuclear Association's conference that is happening today in London. We did attend that virtually, and this is the World Nuclear Fuel Cycle Conference put on by the World Nuclear Association, the WNA, which is a fantastic organization. By the way, anybody new to this sector wanting to learn about nuclear energy in general, the WNA website is an absolute treasure trove of knowledge. I highly recommend you visit that website. In fact, I'll go ahead and put a link in the description of the video here and in the show notes for you to check that out. If you, like I said, if you are a beginning investor in this sector and you want to learn more, generally speaking, about nuclear, fantastic resource. And they put on a great conference today. And there were a lot of gems of information that came from the fantastic speakers. And we are going to put a very thorough take on what we learned today from this conference in the May Uranium Insider Pro newsletter that will be out on Tuesday, May 3rd. So that is coming next week. But for now, I want to share something that Art shared and something that we did hear from one of the speakers today. And this speaker was a woman named Adrienne Hanley. She comes from the IAEA, the International Atomic Energy Agency. And she made a couple of comments about a study that the IAEA has done on the inventory levels for both the US and for Europe. Now, the US inventory levels are recommended to be at least 2 years on average for nuclear utilities within the United States. Over the past few years, we have been right around that 2 to 2.5 year range on average for nuclear utilities in the US. And it's been a bit of a head scratcher because over the past few years, we've seen limited volumes in spot purchasing and limited volumes of term contracting on the part of the US nuclear utilities. However, the inventories would remain relatively stable. Why is that? We would assume that the inventories were being drawn down significantly due to the lower volumes of purchasing. However, what we've come to find out is that the US utilities and the European utilities and global utilities in general have bolstered their inventories over the past 5+ years by purchasing carry trade contracts with traders. So you would see traders buy in the spot market or buy from producers, buy above ground mobile inventory, and they would secure term contract deliveries with utilities. And that would not necessarily be a long-term contract or a spot market, long-term contract from a producer or a spot market purchase. And so that's essentially how utilities globally have kept their inventories up as they've been drawing them down simultaneously. So while we assumed that we would see lower inventory numbers the past few years and they continue to come in, these are the EIA reports in the US that comes, I believe, in May of each year. And at 2+ years of inventory, 2+ years of inventory, 2+ years of inventory. Well, today, Ms. Hanley from the IAEA says that their study is showing that the US utilities have around an average of 16 months of inventory. That's a significant drop on average of US utility inventory. Now, of course, we're going to wait for the official numbers to come out next month, and those are for year-end 2021 numbers. So that could have changed, obviously, in the past 3.5, now almost 4 months since the beginning of the year. So those numbers are not perfectly up to date. So actually, these numbers from the study from the IAEA that Ms. Hanley did mention are likely more accurate than what we're going to see from the EIA numbers that will be coming out shortly. What does that mean? That means that US utilities have been drawing down their inventories in a greater capacity, in a greater volume than they have been replenishing those inventories. And of course, this is on average. Some utilities are certainly secure in their inventories and in their nuclear fuel deliveries out, towards the end of this decade. Some are short-term uncovered and are going to need to secure short, mid, and long-term contracts very soon. 16 months on average of inventory for a nuclear utility is concerning. It's concerning. And she actually stated this as such. This is not a level that the US wants to see in terms of energy security and security of supply. So what does that mean? Now that we're seeing the US confirm that there will be support going forward coming from the federal government for utilities that are, quote unquote, on the chopping block in terms of economic viability in the marketplace for selling electricity in deregulated markets, those utilities can now apply for support from the federal government. So what does that mean? That means that these utilities are going to be buying fuel going forward because they know that they will be getting that support. 16 months on average of inventory is very, very low, historically speaking. Another considerable note on this. So Europe, and I've stated this in the past, that the EU, generally speaking, recommends, if not requires, nuclear utilities to have at least 3 years of inventory. Well, now that we're hearing from Ms. Hanley from the IAEA that the European nuclear utilities on average have just above 2 years of inventory. This is much lower than we've seen in years past. So this is, pulling this all together into basically an assumption that the utilities, generally speaking, over the past 6 months especially, have been drawing down inventories on a global level. And what that means is that going forward, we are likely to see an increased volume in long-term contracting. And that's, of course, one of the core tenets of this thesis of being long uranium equities. And we are likely to see that increase later on in this year. We've already seen that increase in the first 5 weeks of the year, where Cameco reported they had contracted 40 million pounds in the first 5 weeks of the year, which was greater than their entire 2021 contracting volume of 30 million pounds. Not really sure if Cameco will be reporting more volume in term contracts in their conference call, which will happen, I believe, the first week of May. I don't have the date off the top of my head, but that's coming soon. The term contracting has slowed down over the past couple of months after it really took off in the first month of the year. In my opinion, that is utilities are drawing down inventories and they're kind of waiting the situation out for the time being, seeing what is going to happen with Russia and Ukraine. Will they be able to contract going out? And, 6 months from now, if this blows over, if they can sign those contracts with Russia again, they likely will, because they're looking for a consistent, reliable supply that is relatively cheap. And that's what Russia has been for global utilities for decades. So it's a quiet period in the markets right now, in the nuclear fuel markets. Of course, that mostly has to do with U3O8. We're seeing big jumps, like I mentioned yesterday, in the SWU price and conversion prices. So utilities clearly are seeking out new sources from the West of enrichment and of conversion. And those are towards the end of the fuel cycle, like I discussed in depth in yesterday's podcast in episode number 110. So they're seeking out those pounds at the end of the fuel cycle first, and that's going to trickle down to U3O8, especially now that we're seeing these low inventory numbers. So that was a very, very important point that came from today's nuclear fuel cycle conference in London that we were very pleased to attend. And we are going to give, like I said, a greater synopsis on some other details that came from that conference today, which were quite striking. Okay, needless to say, the market is quiet at the moment. The stocks are quiet at the moment, despite the fact that there's bullish news coming in. It's coming in through a fire hose right now. I'm sure that everyone here that is listening to this or watching this does follow John Quakes on Twitter. If you don't, please do. John Quakes, he tweeted something out today that I thought was quite profound. That was that quote unquote locker room talk or backroom boardroom talk within this conference. And I actually didn't hear this today. I wasn't there in person. We were there digitally. So I'm sure that there were other connections and important things to be had and to be heard from this conference in person. But Quakes basically, and this is speculative, right? So this is just kind of hearsay. He's basically hearing that there's another fund that's interested in setting up a similar physical uranium trust that mirrors the same methodology as SPUT, okay? So on top of SPUT and the clear financialization of this sector, we have another entity wanting to set up a physical trust in a similar manner as SPUT. And what do they mean by a similar manner? Well, what is SPUT doing? They have importantly, the ATM, the at the market financing, where they can actually issue shares into the open market whenever they're trading at a premium to NAV. But they also have great transparency and liquidity. So they've done a fantastic job in converting the Uranium Participation Corporation, UPC, into this unbelievably accretive vehicle for investors and for the sector. Now there's another entity that's talking about doing the same, potentially another market. I think that he mentioned, I can't find the tweet at the moment. I think that he mentioned that it came from someone in the UK. Who knows if that'll have anything to do with Yellowcake's vehicle in the UK? Not sure, just speculation. On top of that, we have ANU Energy. This is the entity that already has a $50 million seed, partially coming from CAP, from Kazatomprom, partially coming from the National Bank of Kazakhstan. And ANU Energy already has 50 million in purchasing. We believe, and we are hearing that they do seek to follow through on what they had mentioned during the inception of that vehicle, which is they expected a $500 million follow-on raise to happen in 2022. We are hearing that the plans are still for that to take place. So we're really setting up for a serious run here, and I'm totally fine with seeing the sector chop sideways here and see some panic in the markets, because that's when I start to get greedy. All right, thank you so much for being here. I will see you again tomorrow. Cheers.